It's episode 268, and this week things are going to get interesting, so gather up, hubbers, you're in for a good one. And while you may be worried about interest rates, do not worry, because we're going to tell you exactly what you need to do, what levels you need to be stress testing up to, and of course make bundles of predictions so we can look silly in the future.
Yes, it's that time again. Welcome to the Property Podcast, where every Thursday morning property investors just like you come together to get informed and inspired. Now, just before we get into our conversation about interest rates, a quick reminder that tonight is Meetup Night. Yep, it's the first Thursday of the month. That means that there are over 40 meetups happening around the UK and across the world. They're completely free to attend. There will be no sales pitch. It's just an opportunity to get together, meet other friendly investors, exchange knowledge, stay motivated, and chat about property with someone who isn't secretly hoping you'll shut up in a minute. All you've got to do to secure your place is go over to thepropertyhub.net/meetups, find your nearest event, book your free place, and get along.
Now, Rob, we must stop because we've got a very important news story. Yes, everybody, you need to know this. It appears we were right again, Rob. Oh no, what's happened?
Yeah, good news for us is that we were right. Good news for everyone else is the thing that we were right about is that mortgage rates seem to be getting better for limited companies. As we've said in the past, there's many reasons now to invest in a limited company, but one of the drawbacks of doing that is that mortgage rates have tended to be higher for companies. We said that we thought as the market shifted, that would cease to be the case, and there's an early indication that that is coming to pass. Aldermore, which is a pretty sizable lender, recently announced that their company buy-to-let rates are now going to be exactly the same as their individual buy-to-let rates, so no longer a penalty for investing through a company. So Rob, this is only one lender, but a really encouraging sign.
Hugely encouraging. This is great news. And the fact that one lender has now done it, it will make other lenders look, and competition will force their hand to start moving this direction. We hope. That's what tends to happen. That's what normally happens in the mortgage market. So let's see if that plays out. It's a great sign, and hopefully it's a trend that will continue.
Okay, so this week we're asking, is it time to worry about interest rates? And amazingly enough, we asked the same question right back when the podcast started, almost 5 years ago. In episode 43, we were talking about the possibility of rates rising, because that's what everyone was talking about back then. We said at the time that we didn't see them rising too far. What we didn't predict, and what no one really predicted, was that the next move from there was actually down. They were cut from 0.5% to 0.25%. Now they're back up to 0.5%, and that rise that seemed to be just around the corner 5 years ago seems to be just around the corner again now.
So what we're going to do this week is we're going to look at what will happen when rates actually do rise, and they will, we promised at some point. What should you do about it when that happens? And also, what stress test levels you need to be looking at to make sure you're safe. We're going to cover all of that. But first, let's dig into a little bit deeper about what the Bank of England have been saying. What is their message, Rob? You could say it's been mixed over the years.
You could even say that they've been teasing us a little bit, because when Mark Carney took over as governor, one of the things that he brought in was this idea of forward guidance. And this is where they basically hint in advance about what they're going to do. And what we've seen many times over the last 5 years is hints coming out of the Bank of England that they're going to put rates up. And then when it comes to it, they decide not to do it after all. Part of the reason for that isn't necessarily them flip-flopping, but it's that the hint itself has the desired effect. So if they're trying to slow things down or speed things up, just hinting about what's going to happen makes people change their behaviour. So they're able to actually produce change without having to move the rate at all. Quite clever. Now, recently, it's looked a little bit more likely that they're going to be raising rates soon, and they're actually going to do it this time. Mark Carney said that it would happen in May. The markets very much thought it was going to be May. Everyone was prepared for it. But recently, it's been walked back again, and now it's looking like it probably won't happen in May, but may happen soon afterwards. So there are 9 people on the Monetary Policy Committee who vote on this. Last month, 2 of those 9 voted for a rise, so there's still some more people to convince in order for it to actually happen.
The MPC intends, at a minimum, to maintain the current exceptionally accommodative stance of monetary policy until economic slack has been substantially reduced, provided that this does not put at risk either price stability or financial stability. In practice, this means that the MPC intends not to raise bank rate above its current level of 0.5%, at least until the Labour Force Survey headline measure of unemployment has fallen to a threshold of 7%.
So that's Mark Carney, and that's a really interesting clip, because that's actually back in 2013 when that was recorded. And you can hear Mr. Carney talking about how he will raise interest rates once unemployment levels fall below 7%. Now, unemployment levels fell below 7% quite a few years ago. So did he raise interest rates? Well, no, as most of you know, he didn't. And actually, he reduced them. So his forward guidance may be forward, but there isn't a lot of guidance. He keeps changing his mind. And that's understandable, because this is hard. It's hard to predict interest rates. It's not an easy job. But if the man at the top who's setting the interest rate is struggling to give us forward guidance, how can all of us as normal men, women and children on the street plan ahead?
Well, like you say, they don't really know. There's so much data to consider, so many different factors. It's really impossible to say with any certainty when something is going to happen. So they don't know. We can't know. But one thing we do know is that rates are going to go up from where they are now, and they're probably going to do so in the not too distant future. So it might not be in May, so it's well worth thinking ahead a little bit, not getting complacent with rates where they are now, and thinking about what will happen when rates rise.
Well, the good news is we don't expect much, because rate rises will be gradual. They're not going to jump up to 5% overnight. It may not jump up to 5% for many years, but we'll come to timings a bit later on. What's important to know is that because the rate rises will be gradual, it won't be a shock to the market. It won't hurt too many people, because homeowners have had plenty of time to fix their mortgages now if they want to. With, of course, more recently, mortgages have undergone stress tests to make sure affordability is there. So overall, there won't be a huge shock to the market. But could house prices reduce slightly because of interest rate rises? Personally, I don't think so. If house prices do dampen over the next 18 months, it'll be more worldwide economic factors rather than a UK interest rate rise that I think will be the trigger. We shall see. But Rob, I'd love to hear what you think. Do you think house prices are going to be affected by interest rates?
Well, in general, I do think that interest rates are a big factor, a bigger factor than people think in house prices, as they are in all asset prices. That's probably a bigger topic for another day. I do think it has an effect, but in this instance, I think the changes are going to be so small and so gradual. And again, we'll come to that in a more detail towards the end, that I don't see it making a big difference. We're going through a period of like stagnant or slowly growing house prices anyway. I can see that carrying on for the next little while, but I definitely don't see a trigger from interest rates for any meaningful fall.
So Rob, all that being said, what should investors do?
So clearly no need to panic, but that doesn't mean that there's nothing that you can do. One obvious thing is to lock in your mortgages if you haven't already. If you're planning on refinancing any properties to pull cash out anytime soon, then you might have a reason for keeping it flexible. Otherwise, now feels like a good time to lock in for a longer period of time. The base rate is highly unlikely to go any lower. Mortgage rates are extremely good at the moment. So if you lock in now, then that gives you 2, 3, 5 years of not having to worry about interest rates at all. That's for properties you already own, but for new purchases, there's not a lot you have to do, because if you're using a mortgage, which is really the only time you're going to care about interest rates anyway, the lenders are now stress testing for you. So the PRA rules that came in last year are stress testing at around about 5.5%, depending on various factors. So that's far in excess of where we are now and where the next couple of moves are going to take us. So if the lender is happy to lend at a certain level, you don't have to particularly second guess that.
So ultimately, you should do a portfolio review. If you haven't done one already, do one now. Check where you are. If you're a cash buyer, this doesn't apply as much. But when you do a portfolio review, you should be reviewing your mortgage products. Are they still at a discounted rate? They can sometimes drift and you end up paying more than you need to. Are you in the most competitive product right now? Are you at risk from interest rate rises? Have a look at your whole portfolio, all the mortgages that you have within that portfolio, and just make sure that you're best placed. If you're unsure or not completely confident, as always, we recommend using a mortgage broker. A good one will give you some solid advice here, and it is well worth paying for. Could save you hundreds, if not thousands, if you have a big portfolio. So what should you be stress testing to? Well, if we look back at historic interest rates and where they've been over the years, we can see, and some of our mature listeners may remember, that interest rates in the 80s peaked at 15%. That's right, 15%. So should we stress test at that level? No. Here's the reason why. The world was a very different place in the 80s. Not only was the fashion awful and the music a little suspect, probably rattled a few people now, but the interest rates were not controlled by the Bank of England, they were controlled by politicians. And politicians, quite frankly, didn't know what they were doing when it came to looking after the economy, certainly interest rates anyway. And they played around with interest rates a lot. They put them really high, they dropped them really quickly, they moved them several times over a space of a few months. What this shows is that they didn't really understand how interest rates work, and actually, interest rates, if you change them, the effect on the economy normally takes 6 to 9 months to kick in. So it's not like an instant trigger that you switch. Yes, the markets may move dramatically if it's unexpected, but actually the wider effect on the whole economy does take time for it to filter through. So constantly changing interest rates was a bad idea. But what was a good idea was that they handed over the responsibility for interest rates to economists, a group of economists who now sit at the Bank of England and decide our interest rates moves for us, which is following a model Germany had used for many, many years, and Germany has had a long history of low interest rates post-Second World War. So if we can ignore the peak, what should we look at?
Well, the Bank of England has got a blog called Bank Underground, which is super duper geeky. Half of it I don't understand, more than half actually. But one thing I did understand was they had a really interesting post recently looking at long-term mortgage rates and interest rates. And here's what they found. The all-time average mortgage rate, so going back in the data well over 100 years, was 5%. So that's the all-time average mortgage rate. If you look just at the 20th century, over the whole of the 20th century, the average was 4.5%. If we take a more recent time period and you look at 1997 to 2007, a period that a lot of us will remember, the average was higher at 6.5%. So where you're comfortable with for your stress test depends on how cautious you want to be. I always used to do it at 7%, not particularly thinking that that would happen, but just to be ultra cautious. And at the time when I started doing that, I was guided by that recent period where the average was 6.5%. So going at 7 kind of made sense. Now, realistically, I think that's overkill because, Rob, while interest rates are going to go up by some measure sometime soon, it seems extremely unlikely that we're going to be coming in for a high interest rate period of history. And that's not just our opinion, but that's what all the economists have been saying as well.
Absolutely. Mark Carney himself has recently suggested that 2.5% may be the new normal and that interest rates will really peak there. Now, you could quite rightly argue that Mark Carney's been wrong a lot about interest rates, but he's not a lone wolf here. This is something that we believe, that interest rates won't go that high. And it's all to do with economic cycles as well and where we are within them. And a long-term trend for interest rates shows that this is highly likely, and a period of super high interest rates, while certainly could happen again, won't be for a long, long time. So, stress testing at 5% is probably enough for the vast majority of people listening. It's certainly enough for me. And if you're getting a buy-to-let mortgage at the moment, it's enough for the banks as well, because that's the level they'll stress test to, 5 or 5.5%. So they're doing the stress tests for you. So if you take out a new buy-to-let mortgage now, that stress test at that level is being checked. It's cash flow positive at that point. So you can relax. If you're a big worrier, then absolutely crack on, get worrying. But for most people, ourselves included, we're relaxed. If we're okay at 5 or 5.5% and we've still got a healthy positive cash flow, then we're happy with our investment.
So is it time to worry about interest rates? No, but it is time to be prepared. Rates might not go up this month, they might not go up next month, but they will go up at some point. So it's a great time to be doing that portfolio review that Rob talked about. Because then if rates go up, you'll be prepared. And if they don't, well, maybe that forward guidance is all nonsense again, and we'll be here in another 5 years recording this episode all over again.
Hey, gives us fresh content, Rob. Don't moan. Right, next week's podcast is the perfect accompaniment to this, because this is all up to do with the economy and economic cycles as well. Interest rates being where they are may shock some people, but for those who follow and understand or have a basic grasp of economic cycles, low interest rates right now are to be expected, because this is the trend, this is where it's been going over time. We'll come to that in a minute and tell you exactly what we're doing, but before we do, we've got to thank these wonderful people for 5-star reviews. So first up, Wanna Change Bank says, I've been interested in property, but never knew where to start. The Robs have given me the knowledge and confidence to get started. I've been to RMP and formulated a strategy with them for my future property portfolio, and I'm currently on my first purchase with them. Thanks so much, guys. Thanks for everything. Truly invaluable source of information. Rob and Rob, the ultimate cure for analysis paralysis. And a couple of really quick ones. This one, probably the quickest ever. Praz says, 5 stars, love it. And Floyd50 says, I'm learning about property investment and find these podcasts incredibly useful. Thanks for all your help, guys. Whether it's short, long, or something in the middle, we love your reviews, so thank you so much.
Okay, so next week we're going to be building on this by getting deeper into the economics, so do join us for that next Thursday. And you don't have to wait until then for your next property fix, because we've got Ask Rob and Rob on Tuesday as well. So thanks for joining us, have a great week, and we'll see you soon. Bye-bye.
Bye-bye.
Thanks for listening to The Property Podcast. For show notes, all our past episodes, and to leave a review, go to thepropertyhub.net/podcast.